Indeed, Ben Bernanke said US house prices have never declined. Of course, then they promptly did. But that is par for the course for the Federal Reserve.
Legendary investor Jeremy Grantham is back with his calls, warning of a bubble, this time in the US housing market, saying that as mortgage rates rise, a property crash would be much more dangerous for the economy than a drop in stocks. Grantham, co-founder of GMO, said in an interview with Bloomberg published on Friday that the year 2000 showed you that you can skate through a stock market event, but Japan in 2008 showed you that you can't skate through a housing crisis. I'll break down Grantham's alarm shortly, but first, calling for crashes and bubbles is nothing new for Grantham. Before getting back to housing in the real estate market, here's what Grantham has been calling in the past year with regards to equities. He predicted in January that one of the few great market super bubbles in modern history is about to pop. On top of worrying signs in the stock market, Grantham thinks housing markets look particularly dangerous, he said earlier this year. He noted that $35 trillion of wealth could easily be wiped out in the US alone in a long and drawn-out process. Grantham also said that when pessimism returns to markets, we face the largest potential markdown of perceived wealth in US history, and that mixing 3 asset bubbles together is extraordinarily dangerous, and the S&P 500 could drop 45%. So far, his prediction about the S&P 500 has proved to be prescient, as the index is now down roughly 15% per date. Stocks, particularly in the once high-flying tech sector, have been hammered as the Federal Reserve continues to raise interest rates in hopes of combating levels of inflation not seen in 4 decades. So in response to his call being too early for the drop in stocks, he said, "So far this year, I was very impatient about the market." He admitted, "I couldn't believe how slowly it was coming down and how vicious the rallies were." He also made clear his criticism of the Fed, saying, "All of the economic and financial dangers that are now building up from multiple bubbles do not appear to be considered especially dangerous by the Fed or most of its equivalents around the world." And with clear dangers of an equity bubble revealed in 2000 to 2002, the even greater dangers of a housing bubble in 2006 to 2010, and the extra risk of doing 2 asset bubbles together in Japan in the late 1980s and in the US in 2007, what has the Fed learned? Absolutely nothing, or so it would appear. So Grantham also told Bloomberg on Friday that stocks are selling off sharply as investors begin to realize the world economy has changed dramatically and inflation is here to stay. This was the biggest decline of the S&P in the first 4 months of trading since I was a 1-year-old in 1939, Grantham said. The reality is that this is about as rapidly as any market comes down. Getting back to real estate, in July of last year, Grantham said that real estate bubbles were popping up in almost every market around the world and that eventually there'd be a day of reckoning. Speaking at the Morningstar Investment Conference in Australia, Grantham compared the state of the housing markets across developed economies to the 2008 financial crisis. You can't keep an asset class like housing where the house doesn't change and you're just marking it up in real terms year after year, Grantham said. Eventually, there'll be a day of reckoning. So as we all know, house prices have surged in the US since the start of the pandemic as the Federal Reserve and the government pump stimulus into the economy and the supply has failed to keep up with demand. Grantham argues the US economy can weather dramatic drops in the stock market as evidenced by the merely mild recession that surrounded tech stocks blow up during the dot-com bubble, but when it comes to a housing crisis, he says, the economy is unlikely to come through unscathed. He argues that both stocks and the housing markets have been lifted to unsustainable levels owing to speculation from investors and unsustainably loose monetary policies from the Federal Reserve. The difference between 2000 and the others was that it was far more concentrated. US tech stocks were absurdly overpriced, but much of the economy was still reasonably valued. In other bubbles, real estate prices were high as they are now. Proportionate increases in mortgage rates on the scale we are currently witnessing therefore look very dangerous. So now with interest rates for a 30-year fixed mortgage rising to 5.27% this week, their highest level since 2009, he sees that point coming ever closer. Home prices surged 19.8% year over year in February, only adding to the 19.2% annual gain seen in January. The rapid increase in the cost of housing has led some market experts to back up Grantham's view that the red-hot market is now in bubble territory, including the Federal Reserve Bank of Dallas in a paper published in late March titled Real-Time Market Monitoring Finds Signs of Brewing U.S. Housing Bubble. So Fed researchers said home prices appear increasingly out of step with fundamentals.
Very careful to say, I'm not going to predict when it ends. I'm just going to say that it does end. What's going to bring it to an end?
The thing about the Great Bubbles, 1929 Japan, no one knows after all these years exactly why the bubble peaked. You can say with hindsight it peaked at the point, of course, of maximum euphoria. So there was no hint of darkness at the end of the tunnel. Everything looked absolutely splendid as the market peaked. And of course, as long as it looks absolutely splendid, everybody is happy. The thing about the great bubbles is how intensely do people buy into the idea that it can never break, that prices will never decline. The housing bubble of 2005, 2006 in America was a brilliant bubble in that description. You had people going out and buying a second house to rent because house prices never declined. Indeed, Ben Bernanke said US house prices have never declined. Of course, then they promptly did, but that is par for the course for the Federal Reserve. In 1929, there was a terrific buy-in, and you could read articles in the Ladies' Home Journal saying all you had to do to get rich was to buy stocks and hold on to them. And the same thing occurred in 2000. But in US history, I would say there's a bigger buy-in this time to the idea that prices never decline and that all you have to do is buy them than there has ever been, which suggests that when the decline comes, it will be perhaps bigger and better than anything previously in US history.
Grantham is well known for accurately predicting the housing bubble in 2008, and back in the summer of 2007, Grantham warned that the stock market was like a Brontosaurus, whose brain and nervous system were so inefficient that it would take a long time to realize that it had been bitten in the tail. Sure enough, subprime lenders began to go bankrupt in early 2007, and the stock market didn't collapse until the fall of 2008. So lastly, I just want to look at some bear market rallies from 1929, as Grantham said that the reality is that this is about as rapidly as any market comes down, and that there are no rallies as spectacular as bear market rallies. And this is very true. So looking at this chart of the 1929 stock market crash, you can see that even in its multi-year long decline, it had some spectacular rallies. And as Grantham points out, some of the largest rallies in US stock market history were among crashes and prolonged recessions. So in this chart, you can see just how many times one would have thought it was the bottom, only to be faked out and the Dow to drop even further still.
So even in 1929, you had some magnificent rallies. And buy the dip is the watchword of practically every brokerage house out there. Super bubbles can really wipe you out like 1929 did. And that's where we are now. We entered a few months ago into 3 sigma territory, super bubble territory. And the other great risk is last year we also entered bubbles in real estate. So this is a very dangerous year that we've just had.
And as Ray Dalio explained in his book, Big Debt Crisis, trying to accurately trade in a time like that is nearly impossible, especially because the media can portray such enticing sentiment. Some people are pointing out that Jeremy Grantham is starting to sound like a broken clock, as he's been calling for a huge crash and pointing out this big bubble for years now. And so I've said this before in a previous video of mine. I'll paraphrase a quote from Buffett's biography. One of his golden rules in finance is that financial fraud and speculation often lasts much longer than one can expect, but then subsequently crashes much faster than one expects. Alright, so with that, let me know your thoughts. Is Grantham finally going to get the last laugh or not? And thank you guys for watching.